Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, to end the year, a little bit of a poor 4 days. We had four consecutive losing days to end 2024, but that did not erase the historically very positive uptrend that we experienced last year. Another strong equity rally, again led by the Magnificent Seven last year. Interest rates. Fed has started cutting, but relative to valuations, interest rates are still very high. And equity market newsletters, very cautious. We've had just a little bit of selling, not a very significant pullback at all. Yet we see stock market newsletter forecasters very bearish right now. So this is a chart looking back from 1980, the annual returns, price returns for the S&P 500. And you can see 25% this year, just 1% higher than last year, which is also 24%. These are the 2 years following that bear market that we experienced in 2022. The first time that we've experienced consecutive 20 plus percent returns by the S&P 500 since all the way back in 2000. If you remember, we actually had five consecutive 20% or more returns by the S&P 500 during that time, ultimately led to the end of the tech bubble there in 2000. And you saw those three consecutive years of negative returns. We're not quite there yet. You can see we've only had two versus five. So valuations are not as expensive, but it is something to pay attention to. Very strong momentum during the past 2 years on the heels of 2025. Now, Magnificent Seven has been one of the big drivers in the themes of the S&P 500's performance. This is a look at the past 5 years annual returns for an equal weighted index of the Magnificent Seven stocks. Remember, those are the big tech stocks that have been dominating Amazon, Tesla, Microsoft, Meta, and so on. NVIDIA, obviously, is the big one that came to light the past few years. And you can also see the S&P 500 in the blue, the S&P 400 mid cap in the green, and the Russell 2000 US small cap index in the orange. A couple things that stick out. You can see last year the Magnificent Seven stocks returned 67%, more than double what the S&P 500 did, and more than triple what mid cap and small cap stocks did. And you can see 4 out of the past 5 years, the Magnificent Seven stocks have outperformed all segments of broad market indexes. 2022, during that bear market, was the only time when you saw a lot of selling from those names. But overall, the trend of this rally has been dominated by the Magnificent Seven stocks, the big tech, AI-driven boom. Some of that are valuations that are being stretched, but a lot of that is due to the income growth and the fundamental performance from these industries having a big impact on the overall market in terms of profits and revenues. Now, taking a look at the interest rate picture, we have the 90-day T-bill interest rate in the blue, and we have in the green the S&P 500 earnings yield. Just a reminder, the earnings yield is basically the reciprocal of the price to earnings. So we have a price to earnings of, say, 25, 26 on the S&P 500. That's the price per dollar of trailing 12 months earnings that companies in the S&P 500 are earning. When you look at the S&P 500 earnings yield, again, that's earnings divided by price. So something to remember is the higher that goes, the more attractive or the cheaper stocks are relative to earnings. And the lower it goes, that actually means that prices relative to earnings are actually pretty high. And one of the benefits of using the earnings yield versus the price to earnings ratio that we can compare it to the interest rate environment here. You can see it has been drifting lower during the past 2 years as the market continues to have valuations move a little bit higher relative to earnings, like I talked about. You can see the 90-day T-bill has started to move lower, but it's still at 4.3%, slightly above that S&P 500 earnings yield of 3.8%. High interest rates in the face of above average valuations is not a great recipe. This is one of our concerns from our longer term quantitative models. This has been in place for the past year and a half or so. Interest rates are headed lower, but with only two expected rate cuts, we may continue to see this potential balance be a concern for the equity market. It's nothing like we saw during 18, 19, and 20 and 2021, where interest rate environment really favored risk on equities. We're at a point now where the interest rate environment is not as favorable to equities, but that's been the case during 2024 when we had that strong rally as well, just something longer term to keep in mind. Now, One measure to look at or type of factor to look at when you're in the midst of an uptrend is sentiment. And we did have those four consecutive down days to end the year, and stock market newsletters and sentiment has reacted. This is a look in the yellow, light yellow, the Holbert Stock Market Newsletter Index. That index reflects the average recommended equity market exposure among a subset of short-term stock market timers. So, what is the equity allocation that they recommend for their subscribers? And historically, this is used from a contrarian point of view, right? Trends that are faced with skepticism and pessimism generally haven't reached tops, but when we see a lot of optimism, we want to be a little bit cautious. And we've only had a slight pullback in the S&P 500, less than 5% off that all-time high, and you can see only 35% recommended exposure. So negative sentiment has picked up quite a bit. I would view this as kind of a healthy amount of skepticism. If you see some of the minor pullbacks that we had in April, May period, August, as well as early September by the market. We saw similar reactions to this sentiment index. So I think all in all, this is a good sign in the near term that we're seeing this kind of pessimism and reaction to some of the selling here, but something to keep an eye on is that overall sentiment. Now, to wrap this up, news somewhat unprecedented, but kind of interesting nevertheless. Department of Transportation fined JetBlue Airways $2 million for chronically delayed flights. It's actually the first penalty of its kind. Just a couple notes on JetBlue. They operated four routes that were delayed about 145 times between June of 2022 and November 2023. In calendar year 2024, about 70% of their flights were on time. So about 30% of those flights did not achieve on time. That's a little bit up from 65%. So about one out of every three flights was not on time, and they were a big culprit across the industry. It's only a $2 million fine. They were actually able to drop that to less than $1 million after they received compensation for refunds and things that they gave flight customers over the past year. So somewhat of a slap on the wrist, but more of them trying to send a message across the industry. It'll be interesting to see. It seems like flights are scheduling too tight and maybe unrealistic, and this might cause some reaction. JetBlue and some of the other airliners actually pushed back and said, "Hey, this is some of the TSA and the things that are more government regulated that are causing these." So it will see how this unfolds, but somewhat the first of its kind. And JetBlue, you better get those schedules back on time because you seem to be a big culprit. With that, I want to thank everyone for watching, and I'll see you next time.